Welcome back to HNTA First Year Financial Accounting Part 1. In this video, I will go through SLFRS-15 Revenue from Contracts with Customers. Now let's look at the effective date. SLFRS-15 is applicable for annual reporting periods beginning on or after 1st of January 2018. However, earlier application is also permitted. The new SLFRS-15 provides a single comprehensive framework for revenue recognition, eliminating variations in revenue recognition practices arising from the existing of a series of standards and interpretations. SLFRS-15 has replaced or withdrawn some of the other standards as well as interpretations. It has replaced LCAS 11, Construction of Contracts, and LCAS 18, Revenue, IFRIC 13, Customer Loyalty Programs, IFRIC 15, Agreements for Construction of Real Estate, IFRIC 18, Transfer of Assets from Customers, and finally SIC 31, Revenue Barter Transactions Involving Advertising Services. SLFRS-15 apply to all contracts with customers except the following. Lease contract with the scope of LK 17 or SLFRS 16 leases. Insurance contracts with the scope of SLFRS 4 insurance contracts. Financial instruments and other contractual rights or obligation in terms of SLFRS 9 financial instruments or SLFRS 10 consolidated financial statements or SLFRS 18 joint agreements and LCAS 27 separate financial statements, as well as LCAS 28 investment in associates and joint ventures. Not only this, non-monetary exchange between entities in the same line of businesses to facilitate sales to customers or potential customers also excluded by the SLFRS-15. Now let's look at key terms under SLFRS-15. First one is the revenue. It is the income arising in the course of an entity's ordinary activities. Contract, an agreement between two or more parties that creates enforceable rights and obligations. Customer, a party that has contracted with an entity to obtain goods or services that are an output of the entity's ordinary activities in exchange for consideration. Under SLFRS-15, revenue is recognized and measured using the 5 steps model. First one is identifying the contract or contracts with the customer. Second, identify the performance obligations in the contract. Third step is determining the transaction price. Fourthly, we are going to allocate the transaction price to the performance obligations in the contract. Finally, recognize the revenue when the entity satisfies a performance obligation. Now let's see how we are going to identify the contract or contracts with the customer. Now let's see what is a contract. Contract, defined as an agreement between two or more parties that create enforceable rights and obligations. It could be written, oral, or implied. Does not exist if both parties can cancel without a penalty. An entity shall account for a contract with the customer only when all of the following criteria are met. The parties should approve the contract and they must committed to perform their respective obligations. Then they have to identify each party's rights separately and they should identify the payment terms. And the contract must have a commercial substance. The commercial substance exists when there is a change in the expected future cash flow of the business as a result of the transaction. This change can be due to the change in the risk, timing, as well as the amount. Then finally, it must be probable that the entity will collect the consideration. If not, we can't identify a contract as a contract for revenue recognition. Now let's look at this example. ABC company entered into a contract with a customer to supply an equipment on 15th October 2021. Control over this equipment transferred to the customer on 20th December 2021. The customer agreed to pay 5 lakhs on 31st March 2022. As a result of changes in the economic conditions, ABC company did not believe that it would be collect the consideration that it was entitled as at 31st December 2021. So let's see whether we are able to identify this transaction as a contract for revenue recognition. Now let's see whether this contract is satisfying the criteria under SLFRS-15. In this contract, ABC has approved to supply an equipment. Therefore, we can see the parties to the contract has approved the contract. Then, ABC company entered into contract to supply an equipment on 15th October 2021. Therefore, these parties are committed to perform the contract. Then, the control of this equipment transferred to the customer on 20th December 2021, whereas customer agreed to pay on 31st March 2022. So you can see clearly each party's rights separately. Then the customer agreed to pay rupees 500,000. Therefore, you can clearly see the payment terms. Then, as a result of this transaction, ABC company's future cash flow will increase by rupees 500,000 on 31st March 2022. Since it's affected the cash flow of the company, we can note that there's a commercial substance. Finally, as a result of these changes in economic conditions, it says that ABC company did not believe that it would collect the consideration. Therefore, we can see it's not probable that entity will collect the consideration. Therefore, we cannot account and no revenue should be recognized under this contract. Why? Because the probability or the final step of the criteria has been not satisfied. Now let's see the second step of identifying performance obligations. A performance obligation is defined as a promise in a contract with the customer to transfer a good or service. Performance obligations are identified at contract inception and determined based on contractual terms, customary business practices. An entity has to determine which of the promised goods and services will be treated as a separate performance obligation. This is also known as distinct performance obligations as well. Example, sale of goods produced by an entity, resale of goods purchased by entity, resale of rights purchased by an entity, performing contractually agreed upon task, granting license, constructing, manufacturing, developing an asset on behalf of a customer. SLFRS-15 outlines a two-step process for determining whether a promised good or service is distinct. Under two-step process, first we have to identify explicit and implied promises in the contract. Explicit means promise is clearly stated in its own right. Implied means the promise can be unwritten and enforceable by law based on the actions and circumstances of the parties in the contract. Then we have to assess the performance promises. So, to assess the promises, we have to identify the performance obligation for each promise under two circumstances. Firstly, we have to identify goods or services that is distinct upon satisfaction of following two criteria. First criteria is goods or services are readily available. Second criteria is promises are separately identified by its own, which means distinctive. Then, under the second circumstance, a series of distinct goods or services that are substantially the same and that have the same pattern of transferring to the customer should be identified. However, some revenue contracts contain more than one performance obligations, such as a sale of software with implementation and maintenance, a provide meal at a hotel with a discount of price for future reservation, a sale of an apartment with free maintenance for 1 year. There are three reasons affecting the company's evaluation of performance obligation. The first one is agent and principal. The company have to decide whether these goods and services are to be delivered by them or find an agent to deliver them to their customer. In the case of the delivery by the company itself, then it's said to be the principal. And if they hire a third party, it will be the agent for this delivery. An entity is a principal if it is control a promised good or service before transferring that good or service to the customer. An entity is an agent if its role is to arrange for another party to provide the good or service. The delivery is by the principal, then the amount received from the customer will be considered as the gross amount. The only commission will be recognized as the net amount if the agent delivers the good and service. Second one is additional goods and services. The customer options will have certain options regarding the additional goods and services. These options may include things like customer loyalty points or the discounted renewal for the contract. This option offers an extract right to the customer, then it is called distinct performance obligation. Warranties are the third reason. Warranties are commonly included in the arrangement to sell goods and services. There are two types of warranties: assurance type warranties as well as service type warranties. In the assurance type warranties, it will provide an assurance that product will function as agreed in the contract. It does not give rise to a separate performance obligation. Therefore, the warranty will be accounted under LKS 37 provision, contingent liability and contingent asset. Service type warranties provide something additional to the mere assurance. For example, they provide some extra service beyond fixing defects. It will give rise to a separate performance obligation because they provide additional service to the customer and treated as a distinct performance obligation. They are accounted under SLFRS-15. This means that a portion of the transaction price must be allocated for warranties. Under the third step, let's see how we are going to determine the transaction price. Now let's see what is a transaction price. The transaction price is the amount of consideration to which an entity expects to be entitled in exchange for transferring promised goods or services to a customer, excluding amounts collected on behalf of third parties. Example, some sales taxes. The consideration may include fixed amount, variable amount, or both. Transaction price will change based on the following. Firstly, variable consideration. That can be a discount, rebate, refund, credit, penalty, incentive, or a price concession. Then, the significant financing component. That is the difference between the amount of promised consideration and the cash selling price of the promised good or service. Or sometimes it is the time between the transfer of goods and payment for the goods and services. In this case, we have to take the present value of the discounted cash flow to calculate the significant financing component. Then, the non-cash consideration. Sometimes it may involve property, plant and equipment or a financial instrument as a non-cash consideration. In this situation, we have to take the fair value of each non-cash consideration into account when we are going to determine the transaction price. Finally, the consideration payable to customer. Sometimes we may pay a coupon or a voucher. So this is a reduction of the transaction price. So when we are determining the transaction price, we have to consider the consideration payable to customer as well. Once you have identified the contract's performance obligations and determined the transaction price, you need to split the transaction price based on the relative fair values. The general rule is to measure the fair value based on the standalone basis. Standalone selling price is a price at which an entity would sell a promised good or a service separately to the customer. Here, the estimated standalone selling price can be based on either adjusted market assessment or expected cost plus a margin approach or a residual approach. However, there are two exceptions when you allocate in a different way. When we are allocating with a discount and when allocating consideration with a variable amount. So let's see how we are going to allocate the price based on this example number 2. ABC company entered into the contract to agreement to sell hardware and software and maintenance services for 2 million rupees. ABC company determined that each of the promised goods or service represent a separate performance obligation. Because ABC company frequently sells software and maintenance on a standalone basis. It uses those transactions to determine standalone selling price of rupees 250,000 and rupees 150,000 respectively. Company ABC rarely sells the hardware on a standalone basis. So it is estimated that the standalone selling price at rupees 1,850,000 based on the hardware's underlying cost. So you are required to allocate the transaction price to the identified performance obligation. Now let's see what are the performance obligations. According to contract, ABC agreed to provide hardware, software and maintenance services for the customer. So these are the 3 performance obligations. Now in the question, it's mentioned the standalone price or the separate prices for each contract. The total price together in the standalone prices is 2,250,000. Now let's distribute this allocated price according to the agreement of the ABC company. In this question, it's mentioned that ABC agreed to sell hardware, software and maintenance service altogether for 2 million. Now let's see how we are going to allocate the hardware according to the agreed price. So you can see in this question, we are going to take the proportionate or the fraction of hardware cost from the total standalone price. So the hardware cost is 1,850,000 from 2,250,000. So we are going to take the proportionate of that one and then we are going to multiply it with the agreed price of 2 million. Then we are getting the transaction price as 1,644,444. Now let's see the next one for software. In the software, standalone it will take 250,000 out of 2,250,000. So as a fraction, we can take these two values and then we are going to multiply it with the agreed price of 2 million. So we are getting the value as 222,222. Then for finally, the standalone price of the maintenance is 150,000. Then what we are going to do, we are going to take the fraction of this with the total standalone price of 2,250,000. So we can see, after taking the fraction of this value, what we are going to do, we are going to multiply this with the total agreed price of 2 million. So it will give 134,334. So when we add them together, we can get the total agreed price of 2 million. Once the performance obligation is satisfied, organization should recognize its revenue. A performance obligation is satisfied when the customer obtains control of the good or service. The change in control can be done in many ways. When it comes to company, there are three ways of revenue recognition when it has right to payment for the asset, or the company has transferred legal title to the asset, and finally, the company has transferred physical possession of the asset. When it comes to customer can recognize revenue in either one of this method. The first one is the customer has the significant risk and ownership of the asset. Then the customer has accepted the asset. Once they fulfill this control identification, they can proceed the revenue recognition. Performance obligation can be satisfied either over time or at the point of time. Over time means the control is passed to the customer over some period of time, such as in the contract term. At the point of time means the control is retained by the supplier until it is transferred at some moment. Companies can recognize revenue over a period of time if the customer controls the asset as it is created, such as a contractor or builder construct a building on a customer's property, or the company does not have an alternative use for the asset, such as an aircraft manufacturer built specially a jet for a customer specification. Either the customer receives the benefit as the company performs and therefore the task would not need to be re-performed, or the company has a right to payment and this right is enforceable. Now let's see what are the journal entries for this type of contractual obligations. So first, we may receive money before the fulfillment of the performance obligation at the beginning of the period. When we receive the money at the beginning, we are going to debit the cash account and we are going to transfer the full money received for the contract to the deferred income account, while we haven't fulfilled the performance obligations yet. Then, in the next one, what we are going to do is, when the performance obligation fulfilled, we are going to transfer that income from the deferred income account by debiting this deferred income account, and we are going to credit it into the relevant income account. Then after that, still the consideration has been not yet settled by the customer fully, what we are going to do is, we are going to transfer the amount receivable from the customer to debtors account, and we are going to credit to the relevant income account. Then what we are going to do is finally, we are going to receive the cash from the customer. When we receive the cash from the customer, we are going to debit the cash account and then we are going to credit the customer as well. At the end of the period, all the income realized for the year, we are going to transfer it to the income account from these relevant revenue accounts. Under this SLFRS-15, the most important part is the disclosures. Here, firstly, we have to recognize the contracts with customers. We have to provide how we have recognized the revenue and if there are any impairment losses recognized on any receivables or contract assets, we have to disclose it as well. Then, secondly, the significant judgments and changes in judgments made in applying this standard to those contracts should be disclosed. Under this, the timing of satisfaction of performance obligations as well as the transaction price and the amounts allocated to the performance obligation should be disclosed. Further, companies should disclose assets recognized from cost to obtain or fulfill a contract with the customer. Here, the judgments made in determining the amount of the cost incurred to obtain or fulfill the contract with customer as well as the amount of amortization and the method it used to determine the amortization should be disclosed. Here, under contract balances, the opening and closing balances and the revenue recognized during the period should be disclosed. Then, the quantitative and qualitative information about the significant changes in the balances should be disclosed. Now with this example number 3, I will go more depth with regard into the 5 steps of SLFRS-15. Here, on 1st January 2020, Sigma Company entered into an agreement with the customer to sell an air conditioner along with the maintenance service for 2 years. Sigma Company delivers the air conditioner and the legal ownership of the equipment to the customer at the inception. The customer agreed to pay $120,000 for both air conditioner and maintenance service. If sold separately, the selling price of the air conditioner is 100,000 rupees and the selling price of the maintenance service is 50,000 rupees. So you are required to apply the 5-step model of SLFRS-15 and estimate how much revenue Sigma Company should recognize for the year ended 31st December 2020. Now let's go along with these 5 steps under SLFRS-15. The first one is identifying the contract. In this example, it's mentioned that there is an agreement between Sigma Company and its customer to provide the goods and services as specified in the agreement. Then in the step number 2, what we are going to do is we are going to identify the separate performance obligations. According to the example, there are 2 performance obligations with the contract. One is to sell the air conditioner and the other one is a sale of maintenance services. Thirdly, we have to determine the transaction price. This example specifically mentioned that the total transaction price is rupees 120,000. Now let's move on to the fourth step, which is allocation of the transaction price to the performance obligations. Now in this question, it says the total selling of price of the contract altogether with the air conditioner and the maintenance service is rupees 120,000. So now what we have to do is we have to allocate this transaction price based on the two performance obligations, which is air conditioner and the maintenance service. Question provide the standalone selling price of the air conditioner as 100,000 rupees as well as the maintenance service as 50,000 rupees. Altogether, the standalone price is rupees 150,000. Now let's allocate this based on the transaction price of 120,000 rupees. So what we are going to do, we are going to take the standalone price as a proportionate of the total price. Then we are going to multiply it with the contractual price of 120,000. So based on that method, the air conditioner will give 80,000 rupees as the allocated transaction price and the maintenance service will give 40,000 rupees as the allocated transaction price. In the final step, what we are going to do is we are going to recognize the revenue. In this question, it says that the control over the air conditioner has been transferred to the customer at 1st of January 2020. So, the allocated transaction price of the air conditioner, which means 80,000 rupees, should be recognized as revenue at the inception. Therefore, the double entry would be we have to debit the debtor by 80,000 rupees as well as we have to credit the sales revenue of the air conditioner by 80,000 rupees. Now, the maintenance service is provided over the time. So, the revenue should be allocated to this should be recognized over the time. So, if we are focusing on a particular year, for the particular year, the total revenue of 40,000 rupees should be divided with 2. Why? Because the maintenance service is for 2 years. Therefore, for a year, what we are going to do is we are going to debit the debtor by 20,000 rupees and we are going to credit the revenue from maintenance service by 20,000 rupees. And for the next year also, what we are going to do, we are going to debit the debtor by 20,000 rupees and we are going to credit the revenue from the maintenance service by 20,000 rupees. However, if the debtor is going to pay in cash at the year end, we can debit the cash account and we can credit the debtor and we can set off the debtor value. To have a more understanding with regarding to the allocation of transaction price as well as accounting entries, I'm using this example number 4 as well. ESON is a telecommunication company selling branded tablet units and providing network connection facilities. Company entered into a contract with customer to supply tablet and network facility for 2 years for a monthly rental of 10,000 rupees. The market price of the tablet is rupees 80,000 and the network charge is 5,000 per month. So, you are required to show the accounting entries for 2 years according to the revenue recognition conditions in line with SLFRS-15. As usual, let's move into the 5-step model. The first step is identify the contract with customer. So here, there's a valid contract between ESON and its customer to provide the tablet and the connection facilities. In the step 2, we are going to identify the performance obligations, which is delivering of tablet as well as providing the connection facility. Now in the third step, we are going to determine the transaction price. In this example, it's clearly mentioned that the transaction price is rupees 240,000. Now let's move on to the next step of allocation of transaction price. Since we are familiarized with the proportionate of allocation of the standalone price, I will directly move into the allocation table. So there are two performance obligations. One is to provide the tablet, another one is to provide the connection facility. So in this question, it's mentioned that the standalone prices are 80,000 for tablet and 5,000 per month for connection price for 2 years, which means 24 months, altogether will give the connection facility standalone price as 120,000 rupees. So the total standalone price is 200,000 rupees. Now, in this question, it's mentioned that the customer will agree to pay rupees 240,000 for both tablet and connection facility. So now we have to distribute this among the tablet as well as the connection facility based on the proportionate of standalone prices. Therefore, allocated transaction price of tablet is 96,000 rupees as well as the connection facility is rupees 144,000. Now let's move on to the final step of recognizing the revenue. So we know that there are two performance obligations. One is to provide the tablet and other one is to provide the connection facility. Now let's move on the sale of tablet. So we know that at the beginning of the transaction date or the inception, they are going to sell the tablet. So if we haven't received the money, the double entry would be we are going to debit the debtor by 96,000 rupees and we are going to credit the revenue by 96,000 rupees. So when we are going to sell the service fee for the connection, what we are going to do is we are going to debit the debtor for the monthly revenue. So since the total price is 144,000, we are going to divide it among 2 years, which means 24 months. So the allocated transaction price for this service is 6,000 per month. So what we can do is we can debit the debtor by 6,000 and we can credit the revenue from this service fee by 6,000. But you have to remember this is it. What we are going to do when we are going to record it by monthly. But when we are going to record it for the year, what we are going to do is we are going to identify for 12 months, which means 72,000. So we are going to debit the debtor by 72,000 and we are going to credit the revenue from service fee by 72,000. So this will be the revenue from the first year. For when we are going to record for the next year, we have to do the same double entry, which means we are going to debit the debtor by 72,000 and service fee by 72,000 in the second year as well. Now, in this step, what we are going to do is we are going to record the above transaction in the ledger accounts. Here, there are three types of account involved: debtors account, the revenue from connection fee, as well as the revenue from tablet. So, when we are entering into the contract, at the beginning of the period or the inception, we are going to debit the debtor with the revenue from the tablet, and we are going to record the revenue in the tablet account by crediting it. Then we are going to record the revenue for the connection fee. So here for the period we are going to identify the revenue as 72,000 and we are going to credit it into the connection fee account. Then we are assuming that during the period we are receiving the cash from the customer by 10,000 per month for 12 months, which means 120,000. Then at the end of the year, we are going to balance the debtors account and we are going to transfer the revenue to the income statement from the connection fee as well as from the revenue from the tablet. Then in the year 1, the debtors balance would be 48,000. So we are going to take it down and brought it forward in the next year. Year 2, start with the beginning balance of the debtor 48,000. During the year, we are still providing the connection fee. So we are going to record the revenue for the connection fee as 72,000. We are going to debit the debtor as well as we are going to credit the connection fee account. During the period, the customer is going to pay 10,000 per month for 12 months. So we are going to record the cash received by debiting the cash account and crediting the debtor's account. And during the year, the revenue from the connection fee should be transferred to the income statement. And you can see here, the debtor's account is settled after settling the cash of 120,000. Unearned revenue is the money received by an individual or a company for a good or service that has yet to be provided or delivered. It is recorded as a liability in the company's statement of financial position. Why? It represents a debt owed to the customer. Once the good or service is delivered, the unearned revenue becomes revenue on the company's income statement. This is also known as deferred revenue and advance payment. Digital Limited is a company engaged in selling of brand new laptops and providing internet facilities. On 1st January 2021, the company entered into a 2-year contract with the customer to supply a laptop and internet facilities for monthly rental of rupees 10,000. If this sells separately, the market price of a laptop is rupees 100,000 and the internet charge per month is rupees 7,000. You are required to prepare accounting entries relevant for the year ended 31st December 2021 and 31st December 2022 of Digital Limited. Part A is if the customer settled the full amount at the beginning, and Part B if the customer settled the amount at the end of the financial year. In this question, the agreed contract price of the customer is 10,000 per month for 2 years, which means it will give rupees 240,000. So let's see the standalone prices. For the laptop, it is 1 lakh, and for the internet facility, since the customer willing to pay 7,000 per month for 2 years, it will give rupees 168,000. So altogether the standalone price is rupees 268,000. So you can see there is a discount of 28,000. Now let's allocate the transaction price. So there are two performance obligations. One is to provide the laptop, the other one is to provide the internet facility. So as I mentioned earlier, the standalone price is 268,000 altogether. Then, based on the proportionate of standalone price, we are going to allocate the contractual price of 240,000 among the laptop as well as the internet facility. So, the allocated transaction price of the laptop is 89,552 and the allocated transaction price of the internet facility is rupees 150,448. Now let's focus on part A, which is if the customer settled the full amount at the beginning. Now we are going to record the journal entries for the year ended 31st December 2021. First, when we are going to enter the transaction, the customer will pay money for the contract as a whole. So when we receive the money, we are going to debit the cash account by 240,000 and we are going to credit the deferred revenue account by 240,000. Why? Because still we have not earned this revenue. Then when we are going to sell the laptop, we are going to debit the deferred revenue account and we are going to credit the revenue from laptop account by 89,552. Then for the year, we have to record the income from the internet facility. You know that the allocated transaction price for 2 years is 150,448. Now to calculate the per year internet facility income, we have to divide this by 2. Therefore, per annum, we are getting 75,224 as the revenue from the internet facility. So, this amount should be debit to the deferred revenue income and it should be credit to the revenue from internet facility. These three transactions can be passed in a single entry. Therefore, we can debit the cash account by 240,000 and we can credit the revenue from laptop by 89,552, revenue from internet by 75,024, and we can put the next year revenue from internet facility into the deferred revenue account or sales advance account by 75,224. Now let's see what will be the extracts in the financial statement. When it comes to income statement, we have to record the revenue. So here we are going to separately show the revenue from the laptop by 89,552 as well as revenue from internet facility 75,224. In the statement of financial position under current liability, we are going to record the deferred revenue or sales advance by 75,224. For the year ended 31st December 2022, we have to record the income from the internet facility. Why? This is the only income we are receiving for the contract for this year. Therefore, per annum intended facility income should be debit to the deferred revenue income and should be credit to the revenue from intended facility account. For the year ended 31st December 2022, the only transaction is the income from the intended facility. So in the income statement, we are going to identify it as the revenue from the intended facility by 75,224. Now let's see how we are going to pass the journal entries if the customer settled the amount at the end of the financial year. Even though the customer settled the money at the year end, sale of laptop should be recognized at the point of the customer accepting the laptop. That is, on 1st of April 2021, we should record the sales revenue from the laptop. Therefore, we have to debit the customer by 89,552 and we are going to credit the revenue account by the same amount. Then, monthly, we are going to identify the sales from the internet facility since the customer is paid it monthly. Therefore, monthly, we are going to debit the customer by 6,269 and we are going to credit the revenue from the internet facility by 6,269. But per annum, we are going to debit the customer 75,224 and the revenue account by the same amount. When we receive the money from the customer, we are going to debit the cash account by 10,000 and we are going to credit the customer by 10,000 monthly. But if we receive the money at the end of the financial period, what we are going to do is we are going to debit the cash account by 120,000 and we are going to credit the customer by 120,000. Therefore, for the year ended 31st December 2021, in the income statement, we are going to recognize the revenue from the laptop as well as the revenue from the internet facility. And in the statement of financial position, under current asset, we are going to recognize the balance from the debtor by 75,224. For the year ended 31st December 2022, the only income we have is the income from the internet facility. Since the customer pay at the end of the period, we are going to debit the customer by 75,224 and we are going to credit the revenue from internet facility by 75,224. For the year ended 31st December 2022, the only transaction is the income from the internet facility. So in the income statement, we are going to identify it as the revenue from the internet facility by 75,224. Hunter Company is an experienced manufacturer of equipment used in the construction industry. They charge $600,000 for installation and $4 million for training from its customers. The installation process does not involve changes to the features of the equipment and does not require proprietary information about the equipment in order for the installed equipment to perform to the specifications. Hunter has the following arrangement with Chaya Company. Chaya purchased equipment from Hunters for a price of $2 million and chose Hunter to do the installation. Hunters charge the same price for the equipment irrespective of whether it does the installation or not. The price of the installation service is estimated to have a fair value of $20,000 and the fair value of the training session is estimated at $50,000. Jaya is obliged to pay hunters for $2 million upon the delivery and installation of the equipment. Hunter delivers the equipment on 1st of September 2021 and complete the installation of the equipment on 1st of November 2021. Training related to the equipment start once the installation is completed and last for 1 year. Assuming the cost of equipment is 1.5 million and the equipment has a useful of 10 years, we have to provide the journal entries for this whole activity. So the first step is we have to allocate the transaction price. The total revenue of 2 million should be allocated to the three components based on their relative fair values. In this case, we have to use the standalone price as the fair value. The fair value of the equipment should be considered as $2 million and the installation fee is $20,000 and the training is $50,000. The total fair value is considered as $2,070,000. The allocation should be done as follows. So we are going to take the total of the standard price and we are going to take the proportionate of each performance obligation based on the total standalone price. Then we are going to multiply it with the contracted price. Accordingly, the equipment allocated transaction price is 1,932,367. Installation, it is 19,324. For training, it is 48,309. Recognize the revenue from the sale of equipment once the installation is completed on 1st of November 2021. In addition, it should recognize revenue for the installation fee because the service have been performed. Hunter can make the following entry on 1st of November 2021 to record both sales revenue and service revenue on the installation, as well as unearned service revenue. So let's see how we are going to record the journal entries for the sales revenue. So we can debit the cash account by 2 million and we can credit the service revenue for installation by 19,324 and unearned service revenue by 48,309 and sales revenue for equipment as 1,932,367. The journal entry to record the cost of goods sold is as follows. So on 1st of November 2021, we should debit the cost of goods sold account by 1.5 million and we should credit the inventory by 1.5 million. Hunter should recognize the training revenue on a straight line basis starting on 1st of November 2021. The training revenue per month for 1 year is $4,026. And the journal entry to recognize the training revenue for 2 months in 2021 is as follows. So we have to debit the unearned sales revenue by 8,052 and we have to credit the service revenue for training by the same amount. So what we are going to do for the year ended 31st December 2021 is we are going to transfer the revenue to the income statement. So we are going to debit the service revenue for installation, service revenue for training only for 2 months, and sales revenue for equipment to the income statement. Year ended 31st December 2022, we have to recognize the revenue from the training activity. Since we have recorded for 2 months, the balance portion should be transferred to the unearned service revenue by debiting 40,257, and we should credit the service revenue account by the same amount. Hope you have gained some knowledge with regarding to the SLFRS-15 revenue from contract with customers. If you have gray areas with regard to the conceptual framework as well as gap, go for chapter 1 video. And if you want to know more information with regard to digital controls, go for accounting control in digital environment. Stay tuned and subscribe my channel.